If the US goes to war with Iran in 2026, your mortgage rate isn't going to go down. In fact, it's more likely to go up. And the scary part is, you probably won't feel it right away. There's a specific 3 to 4 week lag between the war headlines on your TV and the moment your bank actually jacks up the interest rates. So if you're sitting on the fence about a purchase, a renewal, a refinance, and you're thinking, I'll just wait for rates to come crashing down or the economy to correct, well, that could potentially be a trap, and it could potentially cost you lots of money. In this video, I'm going to explain why this specific conflict is different from anything we've seen recently, and exactly what you need to do in the next 21 days to protect your family's finances and protect a mortgage application. Usually when something bad happens in the world, like a terror attack or an invasion, investors get scared. When they get scared, they sell risky things like stocks and buy safe things like government bonds. When everyone buys bonds, bond yields drop. And since Canadian fixed-rate mortgages follow bond yields, the general rule is bad news equals lower mortgage rates. And to be fair, in the first 48 hours of a conflict, you might actually see bond yields dip. You'll see people on Twitter or X and TikTok celebrating that rates are coming crashing down. But don't fall for that, because a conflict with Iran has one massive variable that changes the entire equation. That variable is oil. Iran sits right next to the Strait of Hormuz. I hope I'm pronouncing that right. It's a tiny stretch of water, but a massive chunk of the world's oil supply has to pass through it every single day. If that strait gets blocked or even threatened, and it does sound like it's actively blocked, oil prices don't just go up, they spike. Why does this matter for your mortgage? Well, because high oil prices makes everything more expensive: transportation, food, manufacturing, and it creates inflation. And if there's one thing that the Bank of Canada hates more than a recession, it's inflation getting out of control again, seeing as they just got it back down. So even if bond yields drop initially because of fear, if oil spikes, inflation expectations skyrocket. And when inflation expectations skyrocket, bond yields eventually rip up higher to match them. That's what I would call a almost whiplash effect, and it can trap homeowners in higher rates for longer, depending on when you actually look at interest rates. Now, let me tell you what the bank is going to do while this all happens. Let's say war breaks out, right? Which it sounds like it has. It has. Well, the bond yields might drop because of the initial panic. But does that mean the bank is going to lower the mortgage rates the next day? Probably not. Banks are terrified of volatility. If they lower your rate today, but they suspect oil prices are going to drive yields back up in a month, they aren't going to give you a discount. They're going to hold their rates steady to protect their profit margins. And this is what creates that 3 to 4 week lag that I was talking about earlier. So in week 1, the war starts, panic, bond yields drop, mortgage rates stay flat. Week 2, oil prices start to climb, inflation fears start building. Week 3, bond yields reverse and start climbing rapidly to account for inflation and the economy and the pressure. And then, of course, in week 4, your bank sends out an email to people like myself and other mortgage professionals saying that fixed rates are going up by 0.2 or 0.3%. If you waited for the dip that never came, you just missed a window, and now you're looking at higher interest rates, which can affect your qualifying power or what you can borrow, all these different scenarios. So knowing this, what should you actually do? Well, if you are buying a home, don't float your rate hoping for a crash. Work with a mortgage professional who can get you a rate hold for 90 to 120 days, almost like a insurance policy. If I'm wrong and rates crash, great, you can float down and get the lower interest rate. But if I'm right and oil spikes, you're protected at today's rates while everyone else is going to pay more. If you're renewing soon, stop watching the news and look at the calendar. If you're within 6 months from renewal, the 3-week lag could eat up your entire negotiation window. Engage with a mortgage professional or a mortgage broker now. If we see oil spiking, you might want to lock in a renewal early to avoid inflation aftershock. Now, if you're in a variable rate mortgage, this gets a little tougher. If oil spikes inflation, the Bank of Canada might have to keep prime rates higher for longer. They might not cut rates as fast as we'd hoped, and you need to stress test your budget. Can you handle your current payments for another 12, 24 months? If rates were to go up by 0.25% or 0.5%, could you still manage those payments? And if not, then we need to have a serious conversation about the potential of locking in your mortgage, because if inflation does go up, it does put pressure on the Bank of Canada to A, hold rates higher for longer, or B, potentially even increase them. Look, nobody wants war. Nobody likes it. It's terrible for the world. It's terrible for everyone involved. And it's just terrible. And my job here is to make sure that it's not terrible on your finances too. Don't let the headlines paralyze you. The data tells us that oil and inflation are the real risk here, not the initial panic. If you want to run numbers on your specific renewal, purchase, or whatever situation you're in, use the link in the comment down below where you can book a call with me or my team, where we can actually crunch the numbers based on your details. My name is Myles Nowik, owner of the Nowik Mortgage Team powered by Indy Mortgage, and I'm here to try and help you survive the Canadian mortgage market even when crazy stuff like this happens. Thanks so much for tuning in. If you got any value out of this video, make sure to like and subscribe. We'll catch you on the next one.